There is a lot of housing right now that is owned by mom and pop landlords, so to speak. So we're going to see, we've already seen a lot of those investors start to sell. They'll continue to sell their inventory, even with what institutional investors right now own in the market, which is probably 4 or 5% now. And we're talking about the big Blackstones, American Homes for Rent. There's plenty of opportunity.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Paul Pettinelli is an experienced real estate developer and asset manager. After years as a corporate director and executive growing the business, he decided to launch his own company at the age of 39. Paul, welcome to the show.
Thank you for having me.
The pleasure's mine. Paul, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
I started off in hotel management right out of college. Worked in hotel operations for several years. Flipped my first home when I was 22. So when I left the hotel industry, I decided to do it full time. So I started a company, ran it for 3 years, joined a company called Carolina One Real Estate, which led into working as a director for a startup SFR institutional fund. And then that segued into me running Nautic. So basically, I've been very much in SFR, but I have also worked in multifamily and commercial. And so really the hunger that I learned in hotels and watching the corporate guys talk about CapEx improvements really launched my interest in that next level of real estate.
Got it. And so today you guys are focused on the single family residence build for rent communities. Like you're developing entire BFR communities. Is that right? SFR and multifamily, we will do consulting in both, but the investment strategy is primarily single family and build for rent. Camellia House is founded by Jimmy Moore and Jim Eisenmenger. I'm a partner in that company, and we're building it in the Birmingham area. And we're also with Nautic, which is a partner in that. We're doing infill products, property flips, and then we're also doing buy and holds. That's a lot. So you got buy and hold, you got infill, you got property flips, and then
it's all single family though. It's single family investments.
Right. Tell me, I guess, with all these, various pieces of the puzzle, where do you fit into this?
Sure. I mean, my core competency has always been on the asset management, strategic investment side. There's a lot better operations manager than I am. But I'm very good at looking at a plan, the financials of it, assessing the risk, looking at the macro economy. I consider myself fairly well read in investments and what's going on in the world. And I use that knowledge to set the course of where that investment portfolio will be in real estate. And I think, it's been successful. It's been me focusing on my core competency has always made me an attribute to the companies.
And it sounds like you see some good things, obviously, in the future for what it is you guys are building and investing in today. What's the opportunity that you see maybe that other people aren't seeing?
Well, like anything, you manage around the risk and you manage around the obstacles. But the good thing is that the heightened increase in rates slowed down the economy, which in a way it was good. The advantages will be that prices will be more affordable for investments. The prices will come down. The interest in single family, the interest rates are going to soften the market, and there'll be more inventory available. There won't be 10 investors fighting for one home. And then there'll also be a demand in rent, a bigger demand for single family renters. We already saw the demand with the new consumer coming into the single family rental space. This will just exacerbate it.
How do you guys select a market to do a build for rent community?
There's got to be a good amount of land. There's a few things. The land has got to be there, but if you can find enough information to see how much of that has already been entitled, how much, what is the average time from entitlement to getting the right zoning, permitting. Luckily, you can see that information through companies that are already building, not for rent, but building just regular communities. And then, really the influx of people moving into that market. So a lot of the primary and secondary markets are a little bit tougher because you have to really expand outside of that city center. But if there's good growth, then that expansion outside of that main city, those surrounding areas will, if you build the communities, there'll be plenty of demand to fill those houses. So the Kansas City is a good example of just using that as a Midwest market, because Midwest is a great market for build for rent. Kansas City has a lot of opportunity on those outskirts, as well as Birmingham. So Birmingham has that perimeter that is expanding out to. So you build those communities, the houses available in Birmingham may be overpriced. I'm not saying it is, I'm just using that hypothetically. But as long as the demand keeps coming in, the average income of that tenant household keeps coming into that market, that you're going to be able to absorb that inventory.
Right. No, that makes a lot of sense. And you'd mentioned that there's some tenant demographics that you guys are seeing, that you said, hey, this is going to be here for a while. If that tenant pool is not going to be there for a while, but also going to grow. What are some of those? What are some of those demographics that you guys are seeing? You say, hey, this is what we're looking at, and this is why we think that this will continue to be a needed product.
It's basically household formation, and the household income. So, that's a stat that you can look at, but then you can look at the millennial generation, because the average age right now of the household formations and the households that are purchasing homes, getting mortgages, or we're getting mortgages, that same age range is the same tenant demographic that wants to rent a house. May not want to be in an apartment because they do want the lawn, or they want those separated walls. So it's funny. It's anywhere from 35 to 40, and then again later on in life. So that we see that a lot. It's kind of like that barbell. Maybe home. I know my parents are an example. They sold their house and they now rent because they looked at the opportunity of reinvesting that cash into a house opposed to putting it in the markets, whatever, their investment strategy is. And, the opportunity cost wasn't worth it. So we find a very educated tenant that ends up, when I say educated, maybe not on paper, but they understand the cost of owning a home.
Right.
And it's, owning a home is a great thing, but you have to look at it differently than it being an investment, because it can be and it can't be. Just depends.
Right. Yeah, and there's a lot of different ways that you could splice and dice that comment and have a whole conversation about whether or not owning a home is an investment, which we won't get into here today. But do tell me this, like, what's the total business plan for you guys? So you're going to do a build for rent community. You bring in tenants. How long do you hold it? What are the risks? What are the upsides? I mean, what's the whole business plan look like for you?
Sure. Well, as we scale, I'll focus on the Lake Street fund, because that is basically what's absorbing everything, even the bill for rent. So we have about a 7-year window, maybe 10 years to raise, deploy, and stabilize, and then exit. Well, there is a lot of housing right now that is owned by mom and pop landlords, so to speak. So we're going to see, we've already seen a lot of those investors start to sell. They'll continue to sell their inventory, even with what institutional investors right now own in the market, which is probably 4 or 5% now. And we're talking about the big Blackstones, American Homes for Rent. There's plenty of opportunity to purchase that inventory. and build as well, because there's a housing shortage. So the housing shortage, along with the opportunity to be able to take those renters in that want that home, is big. And the risk is jumping into the space, honestly, and not understanding the investment strategy. That's the risk that I see. Housing, and this is not to sound arrogant, you look back years, you have enough data to know how housing will go. You know, I would say it's the safest IRR at that level that you'll get. Because even with multifamily, it's a great investment, don't get me wrong, but you can't diversify your risk. So you can be in many markets, and that's a great investment strategy because you can be in an area of town, you can have 100 units over several zip codes and have your assets protected, even if it's 50 basis points of a drop in value. Now, the first 10 years, we had to figure out how to operate that. Now that there's best practices on how to operate single family at scale, we're able to capitalize on that.
What do you feel like some of those best practices are? Some lessons maybe you guys have learned the hard way?
It's really keeping a good product, maintaining it. I worked for a company that, when I was overseeing asset management and the management section of it, a lot of default landlords were the primary business. So they had just come out of 2008, 2009, and they were very cost conscious. Essentially, every single maintenance item they had to decide on. We have our budgets. We know the amount to operate the home, but the biggest cost in operating a home is the cost of losing a tenant. So if we can maintain a home well, every turnover we're making sure the useful life on the carpet, the paint, everything is crisp and new, because that's the only thing that sets us aside from not every mom and pop landlord. I mean, there's a lot of great small operators out there. When I say mom and pop, I'm talking about anyone under 100 homes. So yeah, just making sure that every home, American Homes Rent is a great example, and Invitation Homes, they have really good products that they roll over, and they don't short the quality of those houses. You move into a house, it's freshly painted, new carpet, maybe not hardwood, but LVP flooring. So you feel like you're moving into something fresh. A lot of times it's nicer than a home you buy. So that is the key point, because tenant moves in, that experience is it's going to be that first impression. If you can keep those retention rates up, you're going to have retention rates up, occupancy up, costs down. The costs you spend a little more on maintenance, even more than you budgeted, you'll end up better off in the long run.
I like what you said there, that the biggest expense is tenant turnover.
Oh yeah.
Occupancy. You lose a tenant for a month or two, and that's an enormous expense.
It mitigates rent control too. You don't want to increase rents too much. You don't want to price out your target market. And so if your costs are high because you're not operating your portfolio, and let's say every operator made up for it by driving rents, well, that's not a good thing, because you don't want to drive the rent past a certain threshold of affordability. If you manage, natural rent increases are needed, but if you operate the retention piece, you can keep their rents reasonably lower, or the rent raises reasonably lower, and you don't have to price out your market.
What's the average tenancy period?
It's approaching 3 years.
Okay.
Yeah, I would say it's about a 70% retention rate. So out of looking at a 5-year window, so let's say your average hold time on that fund or that asset is 5 years. If you're operating it reasonably well, you should keep the tenant 2.5 to 3 years.
Yeah, that makes a lot of sense, and I think that's longer than probably what the average would be, say, in an apartment. And also, again, it goes back to the fact that people want to live in a home. These aren't people that necessarily want to live there in an apartment. At the end of that 5-year period, are you guys selling off those properties? What's the disposition strategy?
Essentially you spend the first 2 years raising and deploying the capital,
Right.
levering it up. And yeah, 5 years is generally the point at which you want to exit out of that special purpose vehicle. The best strategy is you sell that portfolio at a lower cap rate to another institutional investor. But we can extend, if you're offering memorandums or written, well, you can have that extension because maybe 5 years isn't the right window. Maybe you want to extend it out a couple of years. There's 10 years funds out there. There's evergreen funds. But 5 years tends to be the sweet spot.
That's the sweet spot for you guys. That's really, really cool. And I guess the other thing you probably get on brand new build for rent is decreased maintenance costs overall.
It is, yeah. That's definitely a plus. I would say rental home is about 58 to 60% NOI margin. You can get up as high for the first 2 years, 70%, maybe higher. You got warranties. So yes, absolutely.
That's really, really cool. And I guess maybe the last thing, I guess, as it pertains to maintenance, when you have entire families moving into a home, how are you preventing those from just getting, just torn to pieces? I mean, I guess similar problem you'd have in an apartment complex, but I would think a home might even take more wear and tear than an apartment. I don't know. Is that?
Yeah. Well, when you're managing a large portfolio, you have to have the best practices in place, which is screening. You have a lot of times, there's a lot of technologies out there now, which is good for screening where it automates it. There's companies like Rentlease, for example, has a application. It's a lockbox company that has the screening on the back end. If you keep that screening to a level and you're pretty stern on abiding by that, you'll have a good tenant. Not just credit. I'm talking about landlord referrals. Look, you can't catch everything, but for the most part, if they've been a good tenant or if they've been they don't have a huge blemish on their record, it's usually a good sign. If you're just getting heads in beds and you're approving everyone, that's when your turnover becomes an issue. And I'm not saying that they're going to trash a home because they have bad credit. I'm not saying that. I'm just saying as a rule of thumb, people who have looked after their trade line and their credit will look after your home.
Right. No, that's I think that's a fair baseline analysis there. So that's really, really cool. I love what you guys are doing. Certainly the build for rent industry is exploding. Don't see it going anywhere anytime soon. You've shed a lot of light on, everything from maintenance down to finding tenants to, just the where you guys are finding opportunity here in the country, how you're picking your markets and things like that. So certainly have enjoyed having you come on the show today, Paul. Appreciate all your insight here. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
You can contact me on my cell, 843-819-2691, or my email address, paul@nautic.homes. No .com at the end, or just reach out to me on LinkedIn.
Awesome. We'll make sure we put all of that contact there in the show notes. But tell me, nautic.homes, that's nautic.homes, just for those of you who are listening.
Correct.
That's nautic.homes. Paul, thank you again for coming on the show today. I do appreciate it.
Thank you.